Today, I'm not going to segue into anything. I'm going to give her the opportunity, otherwise we're going to run late. She's going to speak to us about unlocking the investors' criteria. She's going to actually give us practical examples on what hotel financiers look for you to be, when they're looking for a financing opportunity. Please help me welcome to stage the Senior Deal Maker Tourism and Service Unit, Katlego Mphahlele.
Thank you. Okay, I don't think I'll need these. Good afternoon, everyone. It's a pleasure to stand in front of yourselves this afternoon. I believe I am standing in between the afternoon sundowners, the Cape Town wine. So I'll try and make it as interesting as possible. My name is Katlego Mphahlele from the IDC, the Industrial Development Corporation. And we are a finance institution wholly owned by government. So I'm going to tell a little bit about how we look at financing, especially not only in hotels. We talk about tourism and the tourism value chain. So let's just get into it. Just to say, by the way, that I'm not alone here. Everybody has been up here talking about and referring to their bosses. I also have a boss. And we will have a Q&A, so I'll refer all the Q&As to him. Okay. I thought we should just quickly start with an overview of who IDC is. We are the largest DFI in South Africa. And predominantly, our mandate is to grow the economy, I think simply put. Our mandate is to grow capacity. We stretch our scope in different sectors by virtue of the name Industrial Development Corporation. Yes, the IDC is quite concentrated in your industrial sectors, mining, manufacturing, and so forth. But actually, we do have, I come from a unit called Services, where we not only look at tourism, we also look at film and media, we look at ICT, going back to our previous presentation, we also look at healthcare facilities, but there's a broader scope that the IDC looks at. And core to core to economic development or growth, obviously is, the big challenge that faces our country, which is job creation. So we are fundamentally looking at those opportunities that speak to unlocking the job, challenges that we have in the country. From a mandate perspective, I think as I spoke about, the sectors, but also we are government-owned under the ministry, the Department of Trade and Industry and Competition, the DTIC. They are 100%, shareholders of the IDC. So intuitively, you would understand that core also to our mandate is, the transformation agenda. And I'll talk about a little bit more about that as we go. We are a DFI. So by virtue of being a DFI, we want to differentiate ourselves to your commercial banks. Essentially, we're actually not here. Our place is not to compete with commercial banks, but our place is to go where the commercial banks traditionally would not go in terms of just the higher risk areas. Yes, we are, owned by government, but not funded by government. I believe the IDC, it's been in existence since 1940, and I believe around that time was probably the last time or era where it was funded by virtue of a budget allocation from government. Yes, we do have certain schemes, we do have certain schemes that we tap into, that we source from government, but those that very funding often, not often, all the time, needs to be paid back to government. So we are self-funding. We're a self-funding institution, but with a heart. We are, like I said, different to commercial banks in that we want to partner with our entrepreneurs. We want to solution together with you. So you'll see, as I speak about tourism and not necessarily hospitality and not necessarily hotels, you look also at the products that I'm going to showcase that we've funded before. We're really just looking to sit down with entrepreneurs, understand the problem statement, understand the economic drivers, understand obviously how we're going to be able to fully fund a project, make sure a project is fully developed and a project obviously pays us back. But we're not very restricted in terms of the type of asset classes within the tourism sector that we look at. I thought it would be beneficial just to also give some financial performance highlights. And the reason for that is just so that we can showcase just our financial commitment to the country, to the industries that we support. Unfortunately, I've got our financial performance for our previous financial year. I believe that we will be announcing our next results on the 28th of August. But essentially, I mean, you can see, yes, all the indicators here, most of them point downwards in terms of, how we achieved in FY24, but all indications are that when we announce in August, we will definitely be showing a better picture than here. But I think essentially you can see from a funding approval perspective, 17.3 billion in 2024, just under 16 billion in terms of actual monies disbursed. And then just going down again to what I spoke about in terms of transformation, 22.3 billion speaks to us partnering together with other financiers in certain projects. That's why that number is a little bit higher than what we would have approved or what we would have dispersed. And the jobs created, 17,826, which we all know is just a drop in the ocean in terms of what really needs to happen. So I think our time here engaging with yourselves and looking to, show the IDC's commitment to the economy is to say that that number should definitely be more. And we're fortunate that we have a finance institution that has the appetite for the industry, that has the appetite to invest in a little bit higher risk than your normal commercial banks in terms of this industry, because my belief is that if there's one sector that is able to generate jobs, is exactly this one, tourism. All right. Overall, the IDC, what we fund loans. I'll go into that a bit more in terms of how we structure the loans. We do have an equity mandate for transactions or opportunities that we consider strategic. And everybody I know feels that their opportunity is strategic, especially if there's job creation, especially if there's transformation. What we look at in terms of what we consider strategic is those catalytic projects which really change the landscape and the lay of the land in terms of where the opportunity is. For example, and I'll point out to it again later, I think it's been widely publicized that we recently invested and still putting in money towards the Club Med resort down in KZN North Coast. And that is one project where we have invested in equity simply because not only is it iconic in that it's the second biggest resort after Sun City that South Africa will have, but also the story surrounding that development from a community impact perspective, from filtering into other sectors, the agro space, the fact that Club Med is also bringing their intel in terms of actually starting up enterprises that will feed into the Club Med resort from an agro-processing perspective and primary agriculture. And other things, there's other unique aspects that we looked at in that transaction. So for those kind of particular catalytic projects, we do consider equity. And how we get funded, like I said earlier, through, we raise funding in the commercial market, our own internal profits, and also, obviously, our own dividends from equity positions that we have in other sectors. Now looking into tourism, just quickly looking at what we do look at in terms of looking at the value chain. Primarily hotels, I would think 90% of our exposure, especially in South Africa, is it comprises of hotels actually. We do look at apartment hotels, and there's a caveat to this because I think there's various ways in which apartment hotels are being structured, just the ownership structure. We will look at those on a case-by-case basis, but what we want to know primarily that when you step into it, it feels like a hotel, it operates like a hotel. Why we're so concerned about that is because that's where the job creation really is. Lodges, guest houses, game lodges, mobile tourism. In the yesteryears before my time, IDC funded the expansion of Rovos Rail, just as an example of what we can look at in terms of what we term mobile tourism. Also, one of the case studies, one of the pictures that I will be bringing up later is a houseboat. In fact, even before my time, the IDC funded the Shaya Manzi houseboat out in Pongola. And more recently, out in Rwanda, we funded the Kivu boat. So I think that just speaks to how broad we're willing to look at, the different, asset classes in the sector. Tourism attractions, that's actually one of my, subsectors that I'm excited about because I just feel that there's only so many rooms that you can build. Maybe in Cape Town, you can do that, maybe Ellen. You can build more and more hotels, but in the rest of the country and in the rest of the country, certainly, I think there's a bigger need for us to actually look at, somebody was speaking about building the tourism destination so that there's actually, it stimulates demand for more rooms. So I think for us, as much as we've been invested in hotels a lot, and definitely that's still our, what we're comfortable with, what we know to do very well, we see the need for experiential tourism because that's actually where the growth is going to come from. We need to invest in the things that are actually creating the demand for those hotels, for that accommodation. So I think that's just a challenge, to the broader audience here to say that as we think about hotels, as we think about room supply and adding to it and the contracts, management, this and that, why are people actually coming to, that destination? And I think the conversation needs to be explored. Sorry. I would have liked to just jump exclusions because it's not nice to talk about exclusions, but I think the list is there in terms of what we don't look at. I think casino gambling, just from a moral point of view. I'll just point out, for example, golf courses, we don't find them on a standalone. The land, we don't purchase land, we require that at the least the project promoter should be able to come to the party having that land, having ownership of that land, and unencumbered. I think that's important, but I'll speak to that later on as well. So from a funding requirement perspective, I think the previous panels have spoken about what makes a project viable, what gives it economic merit. There was talk of, you look at the project sponsors, you look at the destination itself. I think from our side, first of all, it's just really the demand. Because we believe that if there is demand that can either be created or already is there, you can really work around all the other things. Like we said, we sit down with you. Sometimes it does take a little longer, and other people will maybe say the same about working with the IDC or any other DFI. But really the end result, or what we're looking to do, is to just make sure that if we know that there is demand in that particular area, we're able to put together a structure that will work, that is viable, and that will have a return not only for us, but also for shareholders. Structure, what we mean by structure is the debt to equity. So if we're talking solely just pure hotels, especially pure hotels in what can be deemed as your traditional business tourism node. Let me just leave it at that. The equity ask normally is between 40 and 50%, and that's not because we're trying to be hard about it. It really is a function of economic viability. As I said earlier, that our preferred instrument is a senior debt. So over time, we've done these models over and over again. So we know that from a debt affordability perspective, it sits around 60% or 50%. But we do understand that there are nuances. For example, if you look at especially the leisure or your safari, where you've got really high-end properties that really earn high-end room rates. We know that those often, are more viable. The return from a bottom line perspective is so much better that it can actually lessen the load in terms of the equity ask. Similarly to all funders, commercial banks, we do take security in the proposed project together with personal sureties, and where there's room for corporate guarantees, we do take, similarly to any other finance institution. I spoke about the land. Management. There was talk, in previous discussions up here about, whether you're going the HMA route, full operator, full management route, whether you're going franchise and independent operator. I think for us, we just want to know that, well, let me take it a step back. There are instances where definitely a management contract is required, and most of the time it is required. But I think it's very important for a project promoter to analyze what, as they're choosing their brands and the type of management contract, exactly how it meets the return for the business. For example, sometimes you might be investing, or your opportunity might be in a remote area somewhere in South Africa where you don't necessarily need an international brand, because an international brand, part of the value proposition is that they're able to take a lion's share of international travelers coming into the country. Sometimes it's not necessary. For example, in Thohoyandou, we've invested in the Premier Hotel there. It is a local brand, that we've invested in over time, and they've built up their reputation, and they definitely have the muscle and have proven themselves. So on a case-by-case basis, we'll analyze the need for a management contract versus, putting together a management team, and especially for your smaller size projects, let's say less than 100 rooms or so, we'll analyze whether you've got the management team that has the track record that will be able to deliver, and what other types of asset management interventions that can be put in to make sure that there's viability. And in other assets, we will definitely request for a management contract because the market calls for that. Or the need, or in order to actually meet your bottom line, it's assessed as an essential thing. Debt syndication, especially with large projects, similarly to the Club Med Resort, we like to partner with others, especially, I think, definitely with, your big size checks. And especially outside of the continent where we don't have presence. Our offices are only in South Africa. With the rest of Africa, we really do our DDs and everything. We go there for DDs, but the managing and the monitoring and everything is done remotely from South Africa. So we like to have a funding partner that we can sit alongside and rely on their, their presence and their expertise to manage our portfolios together with us. So funding, like I said, we looking at the entire value chain. We look at greenfield startups, we look at expansions, as well as refurbishments. I think there's one thing that people don't really think that we do, which is the refurbishments, but I'll talk to how we fund that later on. I've been told to rush it. So I think the IDC, from a mandate perspective, our funding minimum is R1 million. R1 million doesn't really, it doesn't really excite us, to be honest. You will appreciate that it takes as much work to work on a 100 million project as you're working, on R1 million. But our mandate starts from R1 million. And from a facility tenure perspective, we can go up to 12 years, especially when there's construction. And that's where we provide the moratoriums, up to 2 years moratoriums. It really depends on what the cash flow model outputs from a structuring perspective. And we know that with this industry, it also, it's not every property or every opportunity that just, hits the right marks in year one. So we're able to provide sculpted repayments on the loans, just aligned with how we see the growth of the business. If it's just for refurbishments, we can look at about 6 years, because there we're predominantly funding your FF&E. Also working capital, we can look into that. I think key to how we assess debt affordability, I spoke about the debt and equity ratio, the equity investment that is needed. We look at the financial covenant of the debt service cover ratio, DSCR, of 1.3 times, minimum 1.3 times. I think that's what we try and achieve when we present to investment committee. I said it earlier, preferred instrument is senior debt. In certain cases, we can look at quasi instruments, although they tend to be a little bit more expensive. And then, like I said, in those real strategic projects, we can look at equity. In the rest of Africa, our preference is really in the SADC area. Minimum project size for SADC is $3 million, and for the rest of the continent, 10 million. Like I said, debt syndication is an important one for us. And I think for us, funding into the rest of the continent, there's certain strategic objectives that we would want to see in a project, and particularly from a South African benefit perspective. So the projects that we fund outside of South Africa must show significant benefit to South Africa, whether be it in construction, from the FFNE or from the construction, or even if it's a South African operator going out into the continent. That bodes very well for those types of transactions. Similarly to every other bank, we'll look at getting PRI or CRI. That's the insurance required based on how the country is assessed. And then there is also lenders technical advisory that we would get on board, and obviously appoint a legal counsel in the in-country. And all of that is we request that the promoters look at that. From a funding perspective, I think the market knows that predominantly we have funded previous projects with funding that we sourced from the UIF, which is still under renewal. The IDC did so great last year that it depleted those funds, but those are still under negotiation and renewal. However, in the meantime, we do have funding that we get from the European Investment Bank, where they give us concessionary rating on 50% of whatever loan we look at. I will then skip this one, just to speak about community and workers' trust, because I think, especially in this industry, it's a very important subject to touch on, in that the IDC has a real intention towards solving for the communities and the workers' trusts alike. So we have two different departments within the IDC that actually look at this and provide grant funding, each up to 5 million rands of grant funding, where mainly the objective is really to make sure that there's early realization of benefits. I think it's known that a lot of times where there's been these communities owning structures, which are dependent on some vendor financing scheme, where the community would only benefit after that facility is settled 10 years afterwards, it really creates such strife within a project. So what the IDC seeks to achieve is to say, how can we structure enterprises today where those enterprises will be able to service this particular project and others, so that the community can realize earlier in terms of benefits. I will skip this one. I spoke about, I think, how we are funded, where we are funded. Just to note that we're also a shareholder of Torvest, I think one of the biggest destination management companies in South Africa. And then just lastly, I think just a portrait of, this is what we have up on our wall in terms of the projects that are good and live. We've got the Radisson Blue in Mphahlele. That's one of our proud investments, and obviously the Club Med, it's still under construction, so it still more or less looks like that. And then we've got there up top the Capital Hotel in Bombela, and then the houseboat on Lake Kivu in Rwanda. So I just thought to, display the spectrum of assets that we can look into, and I appreciate the time. Do I still have time for questions?
Yeah, we do.
Awesome.
I wanted time for
Okay.
questions because I think a lot of people want, look for funding. And so if there's any specific questions, we can open up for questions now. Was that a hand? Was that a hand? We have a question here. Is there anybody else? Two. Fantastic. Thank you.
Okay, I'm Mphahlele from Lesotho. So I know that there was a time when IDC was working with LNDC in Lesotho to work on the project. I want to know whether that opportunity is still available, and maybe what are the the conditions, because recently I haven't heard of a new project.
Would that be in hospitality?
Yes.
Certainly, it's still open. I think with that particular transaction, we even advanced all the way to committee. And it just so happened that that committee date was the first week of COVID. And I think, unfortunately, it chased our committee away and the investors, co-investors away. But in a nutshell, yes. Yeah.
Fantastic. Just a follow-up. No, one question each. One question each. So we can give everyone a chance.
We'll talk.
Hi, I'm Manesh Balani from Orsini SPI. Thank you for your presentation. My question is, how do you handle project overruns and the potential that that can cause into damaging your investment that you've made into those projects already?
Yeah, good question. So we've got an internal unit of technical advisors, QSs, environmental health specialists, and the likes. Upfront, when we assess a project, it's very important that the details of the project are at a level where they can be verifiable by our own QSs. So naturally, we talk about drawings being at a certain detail. And we refer to stage 3 detail of drawings because that helps us to quantify the cost to a certain degree of comfort. I think that's number one. And we want to know that there is an independent QS that is in the project, part of the professional, the professional team of the project. So that is very important for us because then we'd be able to also rely on that QS. In some instances, I think especially where our QSs can't, get on a plane and quickly go on site and there's not so much flexibility to maneuver, like maybe up top in the continent. That's where we'll definitely request a lender's technical advisory service to be built into the project. And I think with those projects, definitely our preference is your turnkey type of construction, agreements, EPCs and the likes, because they just give us that added comfort. But yeah, in a nutshell, we've got quite a big team that looks at that. Thanks.
Great. A round of applause, please.
Thank you.
As she makes her way off stage.